Hello everyone, you're very welcome back to the channel. Today, we're going to be answering the question, what is the best emerging markets ETF for European investors? Emerging market ETFs allow you to invest in companies based in China, India, Taiwan, South Korea, Brazil, and many other countries which are classified as emerging markets. There are three indexes which are regarded as being representative of the emerging markets as a whole. These are the FTSE Emerging Index, the MSCI Emerging Markets Index, and the MSCI Emerging Markets Investable Market Index, or EIMI. The ETFs that we discuss will cover one of these three emerging market indexes. For each ETF, I'll highlight the ETF's total expense ratio, the ETF's domicile, the structure of the ETF's dividend status, and the European brokerage platform that the ETF is available on. If after watching this video you want to get started investing in emerging market ETFs, but you don't have a brokerage account, you can try out brokers like DEGIRO, Book0, Trade Republic, or Trading 212 using the links in the video description. If you want to learn which of these brokers is the best for European investors, check out the video popping up on screen after this one. Before we jump into the ETFs, I want to cover the emerging market indexes themselves. The FTSE Emerging Index is made up of 1,980 companies spanning 24 emerging markets. The total value of the index as at December 30th, 2022 was just under $6 trillion. The index has a dividend yield of 3.64%, and the top 10 companies in the index account for over 21% of the index's total value. The MSCI Emerging Market Index is made up of 1,377 companies spanning 24 emerging markets. The total value of the index as at December 30th, 2022 was $6.3 trillion. The index has a dividend yield of 3.36%, and the top 10 companies in the index account for over 22% of the index's total value. Finally, the MSCI Emerging Markets Investable Market Index, or EIMI, is made up of 3,204 companies spanning 24 emerging markets. So right away, you can tell that this index covers much more of the total emerging market. In fact, according to MSCI, the EIMI covers 99% of the total value of the emerging markets, whereas the other MSCI index covers 85%. A similar percentage would also apply to the FTSE Emerging Index. The total value of the index as at December 30th, 2022 was over $7.2 trillion. The index has a dividend yield of 3.36%, and the top 10 companies in the index account for just under 20% of the index's total value. So the biggest difference between the indexes is size. Both of the MSCI indexes have the exact same top 10 companies: Taiwan Semiconductors, Tencent, Samsung, Alibaba, Meituan, Reliance Industries, Vale, Infosys, JD, and China Construction. However, MSCI EIMI covers just under $1 trillion in additional market cap. The FTSE Emerging Index features 9 out of 10 of the MSCI top 10 holdings, with the FTSE Index excluding Samsung, as South Korea isn't covered. This is a pretty significant difference between MSCI and FTSE, considering Samsung is the third largest company in the MSCI index. So that's definitely something to consider when deciding on an emerging markets ETF. But the main point I wanted to make here is that due to the sheer size of the emerging markets index and the number of companies, many, if not all, emerging market ETFs will use what's known as optimized sampling to provide you, the investor, with the index return. S&P 500 ETFs always use what's known as full replication to provide investors with the return of the S&P 500 index. Full replication is where the ETF owns every stock in the index in the exact same proportions as the index itself, which is what you'd expect from an index fund. However, when it comes to emerging markets, this isn't always possible nor desirable. A stock market index shows the stock performance of a collection of company stocks over a period of time, without any consideration for the realities of buying those stocks. Crucially, trading expenses aren't accounted for in the final return of the index. So if an ETF is to provide investors with the index return, then the ETF needs to minimize trading fees insofar as possible. Now, consider the smallest of companies in markets like Indonesia, which are included in the Emerging Markets Index. They're so small that even their bankruptcy bankruptcy would have a negligible effect on the index itself. Shares in these companies wouldn't be very liquid, meaning there wouldn't be a lot of trading activity. That can make the shares expensive to buy. So the ETF needs to decide whether the expenses associated with buying the shares is worth the additional tracking accuracy to the index. In many cases, it's not, and the ETF will either exclude the stock or replace it with a highly correlated but cheaper alternative. The goal here is to minimize expenses while also accurately reflecting the proportionate return delivered by each stock in the index, so that the ETF ends up delivering more accurate tracking than full replication, because full replication for emerging markets would come at a high cost, which in turn would result in returns that deviate from the index. That's optimized sampling. The downside of optimized sampling is that it can produce results that deviate from the index for better or worse. So that's just something to be aware of when investing in emerging market index funds, or indeed any index funds which track a large number of securities. Alright, let's kick things off with ETFs that track the FTSE Emerging Index. Vanguard offers two ETFs that will provide investors with exposure to the stock returns of the companies included in the FTSE Emerging Index. The first of which is the Vanguard FTSE Emerging Markets ETF Accumulating, ticker symbol VFEA. The ISIN for this ETF is IE00BK5B or733. The expense ratio for this ETF is 0.22% or 22 basis points, meaning for every €1,000 invested, €2.20 will go to fees. What you'll find is that emerging market and all world ETFs tend to be more expensive fees-wise than both Europe ETFs and S&P 500 ETFs. VFEA is domiciled in Ireland and is structured as a physical ETF, meaning the ETF actually owns the underlying stock investments. The ETF is an accumulating ETF, meaning any dividends received by the ETF from the underlying stocks will be reinvested rather than paid out to the ETF shareholders. VFEA is available on DEGIRO, Trade Republic and Trading 212, but not Book Zero. The second Vanguard ETF is the Vanguard FTSE Emerging Markets ETF Distributing, ticker symbol VFEM. The ISIN for this ETF is IE00B3VVMM84. The only difference between VFEM and VFEA is that VFEM is a distributing ETF, meaning any dividends received by the ETF from the underlying stocks will be distributed to the ETF shareholders rather than being reinvested. Dividends are paid out on a quarterly basis. VFEM is available on DEGIRO, Book Zero, Trade Republic and Trading 212. Next up are ETFs which track the MSCI Emerging Market Index. This index is by far the most popular index to track, simply based on the comparable number of ETFs tracking each index. As per Just ETF, there are 17 ETFs which track the MSCI Emerging Market Index and only 2 ETFs which track both the FTSE Emerging Index and the MSCI EIMI. But which of those 17 are the best? If we were to solely base our decision on the cheapest ETF, the Lyxor MSCI Emerging Markets Lux UCITS ETF Accumulating might seem like the best option, ticker symbol LEMA. The ISIN for this ETF is LU22001462228. The expense ratio for this ETF is 0.14% or 14 basis points. LEMA is domiciled in Luxembourg and is structured as a synthetic ETF. This means that the ETF does not own the underlying stock investments, but rather uses financial derivatives called swaps to artificially provide investors with exposure to the index return. Synthetic ETFs are inherently riskier than physical ETFs due to counterparty risk, and they typically come with an additional cost on top of the quoted expense ratio due to the use of swaps. While synthetic S&P 500 ETFs are worth consideration for tax reasons, the same is not true for emerging market ETFs, and therefore, in my opinion, it's best to stick with physical ETFs. However, even if you wanted to invest in LEMA, you might find it difficult doing so, given that neither DEGIRO, Book Zero, Trade Republic or Trading 212 offer it. However, its distributing counterpart, ticker symbol E127, is available on DEGIRO. So instead we look at HSBC. HSBC offers two physical ETFs which track the MSCI Emerging Market Index. The first of which is the HSBC MSCI Emerging Markets ETF USD Accumulating, ticker symbol HEMC. The The ISIN for this ETF is IE000KCS7J59. The expense ratio for this ETF is 0.15% or 15 basis points. HEMC is domiciled in Ireland. It is structured as a physical ETF and it's accumulating. HEMC is the cheapest physical ETF which tracks an emerging markets index. It's a relatively new fund with an inception date of June 28, 2022. Prior to HEMC, the iShares MSCI EM UCITS ETF accumulating was the cheapest physical ETF tracking emerging markets, but that has since been displaced. HEMC is available on Trade Republic, but not the Giro, Book Zero, or Trading 212. The second HSBC ETF is the HSBC MSCI Emerging Markets UCITS ETF USD, ticker symbol HMEF. The ISIN for this ETF is IE00B5SSQT16. The only difference between HMEF and HEMC is that HMEF is a distributing ETF. Dividends are paid out on a quarterly basis. HMEF is available on DeGiro, Trade Republic, and Trading 212, but not Book Zero. Last but not least, we have ETFs which track the MSCI Emerging Markets Investable Market Index. iShares offered two ETFs which track MSCI IMI. The first of which is the iShares Core MSCI Emerging Markets IMI UCITS ETF accumulating, ticker symbol EIMI. The ISIN for this ETF is IE00BKM4GZ66. The expense ratio is 0.18% or 18 basis points. EIMI is domiciled in Ireland. It's structured as a physical ETF and it's accumulating. EIMI is available on DeGiro, Book Zero, Trade Republic, and Trading 212. The second iShares ETF is the iShares Core MSCI Emerging Markets IMI UCITS ETF, ticker symbol EIMU. The ISIN for this ETF is IE00BD45KH83. The only difference between EIMU and EIMI is that EIMU is a distributing ETF. Dividends are paid out on a quarterly basis. EIMU is available on DeGiro, Trade Republic, and Trading 212, but not Book Zero. So with all of that being said, what is the best emerging markets ETF for Europeans? The first thing I'll say is that I don't think there's a reason why you would go for either of the Vanguard funds here. They both have total expense ratios of 22 basis points, which is higher than what's charged by the equivalent ETFs offered by both HSBC and iShares. The Vanguard ETFs also track what is an arguably inferior index, given that the FTSE Emerging Index doesn't include Samsung. Samsung is a $200 billion company and represents the third largest holding in any MSCI Emerging Markets ETF. By excluding it, you're not really getting the full emerging markets experience. So that leaves us with the two MSCI indexes. My overall winner here is HEMC, the HSBC Accumulating Fund, tracking the MSCI Emerging Market Index, solely by virtue of being the cheapest emerging markets physical ETF with a total expense ratio of 15 basis points, which is 3 basis points lower than the iShares equivalent. However, a case could be made for EIMI, the iShares Accumulating Fund tracking the MSCI IMI. Although the total expense ratio is 18 basis points, you're getting just under $1 trillion in additional coverage. In other words, you're paying 3 basis points extra to gain exposure to 99% of the emerging markets as opposed to 85%. But bear in mind, each of the additional companies in the IMI will be very small size-wise, and their individual share performance will likely have a negligible impact on the ETF's returns. Also, because of optimized sampling, the extent to which you have exposure to each of those additional companies will likely vary. So you need to answer the question, do I want to pay an extra 3 basis points for an additional $1 trillion worth of coverage? And if so, do I know why? So now that you know the best emerging market ETFs for Europeans, you might want to get started with investing. Again, if you don't have a brokerage account or you want to try out a new broker, you can sign up to DeGiro, Book Zero, Trade Republic, or Trading 212 using the links in the video description. Using these links supports me as a creator and lets me know that you found this video to be useful. What emerging markets ETF do you think is best for European investors? Have I missed any contenders for the #1 spot? If so, let me know in the comments. Thanks very much for watching, and I'll see you soon.